Hi and welcome to this week's edition of Macro Minutes. I'm your head of trading, Mark Gardner. We'll start with the disclosure statement. The information summarised in this webinar does not constitute financial or professional advice and is general in nature. It doesn't take into account your specific circumstances and should not be acted upon and without your full understanding of your current situation and financial and future goals. All right, so stocks in our universe this week, we've got OML, Megaport and Helios. So OML, although no official announcement was released to the ASX this week, new CEO Cathy O'Connor hinted at the possible sale of Junkie Media to several news platforms and discussed plans to enhance digital out-of-home products, offering amid global structural shift to digital assets. OML has brought its content creation arm, Junkie Media, for 11 million, and as an attempt to diversify its portfolio of the business with the addition of a youth-focused digital publishing business. However, it hasn't really gone to plan. Junkie Media booked an asset impairment loss of 2 million and a 12% decline of revenue from the operating segment it belongs to. That was in 2020. So plans to sell Junkie Media are part of a new strategy to grow that digital out of home by developing customer education tools, which when combined with the new technology of programmatic trading of the advertisements will make the DOOH as attractive as other digital channels that have captured the attention of media agencies and advertisers. The new strategy will leverage OML's exclusive rights to biographic data and insights from Quantum, mobility data from DS Spark, as well as its bespoke and audience models. Furthermore, Move 2.0, an improved version of the current industry audience measurement system, is expected to launch in 2023. Which will include the DOE audience measurement. Look, whilst it's not, a great thing that they've paid too much for this asset, etc. I think the management is showing good discipline here. It's probably not going to be great for them in the short term, but I think taking it on the chin and basically dealing with the problem and developing it into usable assets is not such a bad idea. So fairly happy with management there, just not the, obviously not the decision for the purchase price, but these things happen. Rightio, now on to Megaport. So Megaport reported its Q4 update on the 9th of this month. Strong quarter-on-quarter growth in all metrics. Megaport has created a software platform that provides business an easy way to create and manage network connections. By creating a high-speed interface called Port Businesses, businesses can create point-to-point connections between any private cloud servers to a connected cloud service provider. Recently, 100 gigabyte per second customers accessing ports steadily increased. Therefore, Megaport has been building up additional port inventory to stay ahead of the demand and accelerated deployment of 100 gigabytes per second port speeds. It reported an 11% increase quarter-on-quarter monthly revenue and 16% increase in revenue quarter-on-quarter. An expanded ecosystem across all regions with 3 and 4% increase quarter-on-quarter enabled and installed data centers respectively. Megaport also achieved its network footprint target for the financial year with 405 installed data centers. Strategic partner of Megaport Digital Realty, recently disposed of their remaining shareholding in MP1 on the 1st of the 7th, the new financial year there. It has 136 million in cash reserves and is well positioned to continue to invest in their revenue engines. Next up, we've got Helios. It's been an investing wreck for a while. It's also been a trading wreck. I think the trading we hit price target fairly recently, but it's continued to rally. They reported their division rebranding and an acquisition on the 12th. Its imaging division has been rebranded to Loomis Imaging as a step towards unifying its imaging business under one national brand. These businesses span across Australia, and unification will increase customer focus, develop their online presence and modernise its competitive advantage. The rebranding will take about 18 months. Helios also acquired Axis Diagnostic, a Queensland-based imaging business with an EBITDA of about 2 million. The acquisition has been funded through cash and is expected to be EPS accretive. The acquisition is expected to grow the imaging footprint, revenues and capabilities across Queensland with 3 practices located in growing areas near business and one in the Whitsundays. I think that price is up around about the 280 mark. They're expected to report well as well on our initial preview of the reporting season with the research department. So at the moment, it's definitely worthwhile holding on to those Helios. And you'd probably be buying any dip if it dips back to 440, 450 or something like that. From a trading aspect, for those of you who hold it, well done. Rightio, stocks to watch out for. We've got CIMIC, NOL, Noble Oak, and Milton Corp. Rightio, we'll start with CIMIC. They're expected to report their earnings on the 21st. They're an ASX construction, mining and services company that operates across life cycle of assets, infrastructure and resource projects. Last week, SIM investee Ventia Capital Group secured a $400 million contract with NBN Co, which will support NBN's plans to extend the fibre deep into communities. It will provide about 8 million premises on the fixed line network. The company is expected to report a 59 cents per share EPS and provide additional visibility regarding its strategic outlook. So things looking good there for CIMIC at the moment. Next up, we got Noble Oak Life Limited. So they're set to hit the bourse on the 21st of July. So this is an IPO. The company specialises in life insurance, income protection, trauma insurance. It'll issue 62 million shares at 195 a piece for 160 mil market cap. The money will be used to broaden the company's shareholder base, provide a liquid market for the group's shares and increase its brand profile. So yeah, look, insurance will start to do a little bit better as we start to get higher interest rates. So it's probably one to keep an eye on, given you've got limited other options there really in this sort of in that sort of industry. Probably similar sort of tailwinds to maybe what Challenge is going to have with the rising interest rates as well, with the sort of annuities and things like that. So. Next up, we've got Milton Corp. They'll be announcing their results on the 23rd of July. It's a long-term investor in companies, trusts, interest-bearing securities and property. It seeks to invest in well-managed companies and trusts with profitable histories and the expectation of a sound dividend growth. The past month saw the company acquire Washington H. Soul Pattinson at a price of $6 a share, created a $10 billion investment company with Milton shareholders receiving an 8-cent final dividend. In the upcoming report, management is expected to provide insight into combined entity's strategic outlook. It's expected to use its larger balance sheet to finalise a number of deals. I think Soul Pattinson's, I don't think has ever missed a dividend, so it's incredible company, that one. So hopefully their strategic outlook lines up quite well, and there's some improvement. So yeah, but they've been fairly reliable. So we could see some fairly good things from this company, I suppose. So we're going to look ahead to US, Australian and retail sales, ECB policy statement. So tonight we got US retail sales figures. It's the earliest available data on American consumer spending, which accounts, for the majority of economic data. They are starting to get back out there in the US, particularly sort of New York and California, with the vaccination rates quite high there. Even though they've got some higher COVID rates, it tends to be in pockets. And the employment, while it's sort of there's some structural issues in the US at the moment, there is more than enough job availability to cover the amount of people who are unemployed. So once the economy starts moving around at the normal pace, or as close to normal as we can possibly get to post-pandemic, those things will start to improve. Look, one thing we do need, we've discussed this week, is that we do need to, for those of you in Sydney and now Melbourne, as of today, we need to keep in mind that the rest of the world is ahead of us now. I think in the OECD nations, we're last in terms of vaccination rollout. So whilst we're, we can possibly get a little bit too negative on the, because we're going through lockdowns at the moment, realistically, the rest of the world and most of the other major capital cities in Australia are really not experiencing this this downturn. It could provide little opportunities, I think, stocks like Tyro might be unfairly dealt with, and I think that they're going to go quite well once we come completely out of lockdown. So that could provide a really good little opportunity to be buying around about this 350 mark for those sorts of things. So yeah, just have a bit of perspective there in terms of COVID. Next Wednesday we'll have Aussie retail sales. It's it can be a volatile number. Really isn't what the RBA is focusing on. We did have Aussie unemployment yesterday, growth of 29,000 jobs. They're expecting 30,000. That was getting a bit of a tail end of the numbers, accounted for a little bit of the lockdown in Sydney, although Sydney wasn't taking it very seriously at that stage. But the unemployment rate did drop to 4.9%. Which is mining boom levels. So Australia's doing pretty damn well overall. Everyone's got a job, and we've got a lot of stimulus still hanging around, and the property market's going fantastic. Aussie dollars down, resource, commodities are going up. Our exports are going to really take a massive chunk out of that, the deficit created by all the stimulus. So realistically, Australia's got a pretty rosy outlook, even though we're going through a little bit of uncertainty due to the lackadaisical way we handled the vaccine rollout. I think overall now these lockdowns will really push the vaccination rate higher very quickly. Personal experience was I could get an AstraZeneca vaccine, on the day, which I obviously had. And look, it's widely available these days. So it's nothing more than a disclaimer. So we'll start to see those record numbers, like the 800,000 people receiving a shot 2 weeks ago in one single day. You start to ease concerns there. We've also got ECB monetary policy statement next Thursday, and then they have a press conference. There's been a fair bit of talk between the finance ministers, etc., over there. Christine Lagarde's basically saying that there is zero chance they're going to be tapering anytime soon or anywhere near ahead of schedule. They're probably the most verbally committed to this living with inflation concept that central banks are now adopting. Although Jerome Powell's been talking to the Finance Committee, his testimonies over the last few days, he's been grilled on inflation and whether the Democrats should be doing further stimulus, and he's batted that away, basically saying they are committed to living with inflation. So we will start to see a little bit of a shortening of timelines naturally on interest rates. Look, even countries like New Zealand basically are expected to tighten very soon, actually, and they've completely halted their bond buying program. But obviously a very small country, and there'll be outliers with this. But as long as the major global central banks are sticking with it, we don't sort of really expect to see too much movement there, or too much structural change into our general outlook. So we're very focused on reporting season. Our research department here at Maqro has an extraordinary record over reporting season. So please make sure you're reading your reports and reading your updates, because over the next 6 weeks we're going to have some really great opportunities. And of all the periods of the year that you should be reading your macro research, February and particularly now are the other times where you're probably going to benefit the most from it. So I think we had about an 80% plus hit rate last time on picking companies that beat expectations, and I think the main focus for us is in the materials and financial and tech sector. So thanks for attending the Macro Minutes on the 16th of July. We will chat again next week.